All right, so with FIFO, no, sorry, LIFO now, perpetual, I have at 110, right? I stop here and I decide what 1,000 units did I sell? So I have 1,000 units sold. Not going to bother with the debit to accounts receivable, the credit to sales revenue. That would be recorded, but the difference between this and the FIFO example is only going to be in the cost of goods sold, right? The sale price doesn't change based on which cost flow assumption I'm using. It only alters cost of goods sold and inventory. So need to figure this part out. 1,000 units sold. What's my most recent purchase? Well, that's the stuff that came in right before it. Do I have enough units? Well, I ordered 1,100. I returned 70. I have 1,030. So yeah, I have 1,000 that I can pull from, and I will take all 1,000 of those units at 834. Don't even have to double stack or go through 2 layers. It's going to be 8,340. That's my cost of goods sold and inventory for that date. Now on 130, I make another sell. This time I sold 500. Same entry, cost of goods sold inventory. Sorry, same accounts in the entry. Of course, my dollar values will be a little different because now I'm at 130. My most recent units are these 400. So I'm going to take 400, no returns, so I don't have to worry about that. Price them at $10.30 each. That's going to be a total of 4,120. But that's not all. I need 500. So I'm going to take the next 100 from the next most recent layer, working backwards here. If I have 350, I return 20. I have 330 remaining. I have more than enough to cover the 100 that I need to get me up to 500 total units here. And that's at $9.23 per unit. And so that's going to come out to a clean $923. Summing those two guys up, it's going to give me $5,043. That's my cost of goods sold. Taking those two together gives me my total cost of goods sold. That's 13,383. And to get my ending inventory, again, I can just go and take gas, subtract off my total cost of goods sold to get the ending inventory. So 17,156 and 10 cents minus $13,383 gives me $3,773.10. So again, remember, this would be my ending inventory prior to shrinkage. Because I wasn't looking at anything about the final dollar, the final count here. I was just working with my purchase and sales data. And as we discovered prior, we have 10 units missing, right? We should have we've counted 450, we should have 460. So 10 units are missing. What cost do I want to ascribe to those 10 units? Well, what's available, we still have units available here. We only sold off 100 of them. We have units available for here. We sold all but 30 of those, and we still have all 200 here. So which one do I want to take? In this case, because we're using last in, first out, let's put that cost at the most recent purchase, which is here, right? The most recent to my date and time would be here. So those 10 units would be at a price of $9.23 each. So the shrinkage, and this is just a happenstance, a coincidence, it's not always going to be this way, is going to give me $92.30 of shrinkage. I would record that with loss on inventory shrinkage. And a credit to the inventory account. 92.30, 92.30. So if you're thinking about this in a T account way, which is to me usually the best way to incorporate accounting, right? We started with beginning inventory 1400. So that was where my inventory account started. Bringing this back into a more holistic idea of all the stuff that's been recorded. We've only been concentrating on cost of goods sold, but yeah, we had purchases, we had a couple of sales. All of that would have given me the 13,000, sorry, not 13,000, the $3,773.10. This would be an unadjusted balance. So think about your unadjusted trial balance from the beginning of the course. Well, when I then adjust it with a credit of 92.30, get the calculator just to make sure I do it right. I have 3,773.10 as my unadjusted balance. I subtract off the 92.30. That gives me 3,680.80. That would be my, sorry, that T account got a little lopsided there, but that would be my adjusted balance after I adjusted it for that inventory shrinkage. That's how that would play out between unadjusted to adjusted balances. That's what I meant about this is my ending inventory prior to shrinkage. So prior to that adjustment, it's this amount, but then I incorporate that to bring it to its true value. This is the true value of my physical count. All right, got one more method to calculate, and this one can be a little tedious because you're having to construct averages at each point in time. So at 110, I need to figure out what was the average cost of the inventory at that date. Okay, so I can, provided I have this gas out here, I don't have to recreate everything, but I will recreate the numbers just to show you. I do have the 200 at 7. That's part of the inventory I have at 110. The other part is this purchase, but I only have 1,030 units at the price per unit. And so that's going to give me 1,400. We already know that the other one gives me 85 up here, 8590.2. So in total, the amount of goods that I have is nine, or the dollar value of goods that I have at that date are $9,990.20. Now to come with the average price per unit, right? This is the total cost of all those units. This is based on the average price of 1,230 units that I have. And that gives me, rounding to the nearest cent, $8.12. And I will tell you to round to the nearest cent on a problem so that you can get it. I'll also put a range so that you can go a dollar up or down based on rounding and it'll still be correct. So you should be fine. Just round appropriately. You should get it on the head. If not, you have a little bit of a bias that you can round on. I don't want to count anyone wrong for rounding errors. It's silly. All right, so that's our cost per unit. Then it becomes an easier haul from that point because all we have to do is say, okay, well, if that's the average cost per unit, I sold 1,000, then that means I take that number, multiply it by 1,000 units, and that will give me 8,120 cost of goods sold inventory for that amount. So remember, all we're doing is ascribing a cost of some rational systematic basis to what I've sold. Okay. Now on 130, we got a couple more. We got one other little hiccup coming in because we had 1,230 units at $8.12. I sold 1,000, but there's still 230 units, and those 230 units had a established average price of 812. So coming forward, I need to keep that in my memory bank that I still have 230 units at a price of $8.12. But I also have additional purchases, right? Because the moving average up to January 30th would encompass what's left here and anything more that I bought. So that's that. What's left is the first thing I record. Then I go to 350, but I return 20. So I have 330 at a price of $9.23. And then 400, the final purchase times $10.30. I do the math on these guys. 1,867 and 60 cents. 3,045 and 90 cents. 4,120 dead on. All those added together give me 9,033 and 50 cents. And now we have to say, well, how many units is this based on? It's based on 230, 330, and 400. So that is in total. Oop, wait. Nope, nope, nope. Sorry, made a mistake here. Let me remath a piece of this. 330 times 923 is, okay, so that is okay. I just want to check all this. So I thought I got off. Okay, nope, we're good. Divided by 960, right? 230, 330, 400 gives me that. To get that average price, then I divide by 960 units, and that comes out to $9.41. Again, round to the nearest cent. In order to come up with the cost of goods sold at 130, my entry at 130 would be, of course, the debit and the credit there. Under the perpetual method, always that simple entry. And I multiply that by 500 units. Gives me 4,000. 4,705. All right. So I got a cost of goods sold of 4,705 there. And a cost of goods sold of 8,120 there. So I add those together to get the total cost of goods sold. 12,825. And I subtract that from my goods available for sale. That gives me the ending inventory before adjustment for shrinkage. $43, 4,331 and 10 cents. And then the shrinkage, right? 10 units are missing. Take your most recent moving average. So now the shrinkage would be $94.10. Again, would reduce net income, and this would reduce assets. This loss on inventory shrinkage, sometimes companies will just roll into cost of goods sold. They will have to note in the financial statement footnotes that cost of goods sold includes the loss on shrinkage. But they will sometimes just embed it in that. If they don't, it is an operating expense. So that's where it would place on the income statement since it's a new account, a new expense account. Like to track those for you. So those are the rough calculations. Some of them are a little more tedious than others. Got to dot your I's, cross your T's, make sure that you are keeping track of what's returned. That's a big one. That can screw up some calculations. Make sure that you know how to develop the price per unit. And know how to work FIFO and LIFO basically at each point in sale. Are you grabbing the oldest? Are you grabbing the most recent? And that is how we calculate cost of goods sold.